All right, looks like we have a good number of people here. Welcome to Managing Market Volatility with Alternative Investments webinar. This is featuring Howard Hill, the Managing Director of Institutional Business Development at ClaraPHI. I also want to introduce Urban Catalyst. Urban Catalyst is a real estate equity fund focused on ground-up development projects in San Jose, California. Urban Catalyst is also an opportunity zone fund, allowing Urban Catalyst investors to receive the tax benefits associated with the opportunity zone legislation. Here are our disclaimers. So today, we're going to start off with introductions. Then we're going to talk about some current market observations, alternative investments in general, and how they can provide stability to an overall portfolio. And finally, why would you invest in opportunity zone funds, especially opportunity zone funds in San Jose, California? What are the advantages? Also, just as a housekeeping item, we will have a Q&A session after the presentation. Please fill out any questions you have in the Q&A box. We will get to all of your questions when the presentation ends. I am Erik Hayden. I'm the founder of Urban Catalyst. I've done over $3.5 billion worth of ground-up real estate projects throughout the Bay Area and California. You know, I've been a real estate developer for over 15 years, and really my experience is the entire real estate process. So everything from land acquisition, due diligence, entitlement processing, financing, construction, management, and eventually disposition. So really, real estate development soup to nuts. At Urban Catalyst, I started Urban Catalyst in 2018. Wanted to bring on an all-star team of the best downtown San Jose developers. You know, really saw downtown San Jose, that light switch turn on around 2.5 years ago. Also kind of interesting, wanted to start a real estate equity fund. It was only after I starting the fund that learned about opportunity zones and that all of downtown San Jose had an opportunity zone overlay and how we became an opportunity fund. I brought on Josh Burrows and Paul Ring. Josh and Paul, two of the best real estate developers in downtown San Jose, just a ton of experience building a variety of different project types. Also, because we are a real estate equity fund, I brought on Morgan Mackles as our head of investor relations. He and his team and his plan have made it so that we've raised over $60 million to date for our fund. We plan on raising between 125 and 135 million before we close fundraising at the end of the year. Finally, I brought on Sean Raft. Sean is an attorney. He also manages all of our internal accounting and financial processes. He makes sure that we're in compliance not only with the Opportunity Fund legislation, but also with the SEC and all of these other governmental agencies. Sean, I like to say, really dots the I's and crosses the T's when it comes to making things run at Urban Catalyst. Just as an example of some of the past projects the Urban Catalyst executive team has done throughout our careers, institutional quality projects throughout the Bay Area, really an impressive list of things that we have accomplished in our careers. And, you know, when you look at real estate equity funds, what you really want to look for is what are the projects, who are the people doing those projects, because past experience and track record are the best indicators of future success. You know, we're doing projects in downtown San Jose, and I want to briefly talk about San Jose before I introduce Howard. The three things that San Jose has that we really want to see when we do ground-up development anywhere. The first is we want to see demand for all of the different types of projects we're building. We're building 7 projects in downtown, and there's a demand for all 7 different project types because of the Silicon Valley job engine. We also want to see transit and physical infrastructure already in place, and San Jose has that in spades. It's the only true urban environment in Silicon Valley. It has Diridon Station, which is the largest train station on the West Coast. You can get on Caltrain and get to San Francisco in around an hour. BART, which is the regional medium gauge rail transportation system that goes throughout the Bay Area. It is connecting to Diridon Station here in the next 8 years, and it's fully funded. So that's coming right into downtown. And later on, when I talk about some of our projects, I'll talk about their proximity to those future BART stations. And last but not least, when we talk about transit and physical infrastructure, we have to mention San Jose State University. It's right in the heart of downtown with 45,000 students and 12,000 faculty. It's one of the largest universities in the Bay Area, second only to Cal Berkeley. And finally, and most importantly, when we talk about what we want to see when we do ground up development projects, we want to make sure the local government wants to see development happen. You know, it's hard enough in California to do ground up development. It's, you know, it's almost notorious. It could take 3 or 4 years for a medium-sized project to get to building permits. Here in San Jose, they have an extremely streamlined process. The politicians want to see development happen. That's a picture of my partner, Josh, and I with the mayor of San Jose. It's really his programs that he's put in place as he's been the council member for downtown and the mayor for 14 years now. Now I'd like to introduce, the star of our webinar today, Howard Hill. Howard is the Managing Director, Institutional Business Development at ClaraPHI. Howard has 30 years of experience both in equity and alternative markets. And not only that, he has significant experience as a real estate developer himself, as well as being an equity provider. Howard is a good friend of mine. Howard, welcome to the webinar.
Thank you, Eric. I appreciate the opportunity to be here and chat with you guys and give us the opportunity to talk a little bit about the alternative investing space. Real quickly, I'll just tell you about ClaraPHI. ClaraPHI, well, I'll start with myself, I guess I should say. As Eric said, I've been in the business for quite a long time, and a number of different areas that I've worked in, including spent a lot of time with alternative investments, and really have fallen in love with the world of alternative investments quite a long time ago, and have taken numerous paths to try and develop and deepen my experiences within the space, so that when we go to talk to folks, that hopefully I can bring some credibility in the space and how it applies to the overall space of investing and helping consumers and investors, the retail investor, provide the best possible experience for their clients. A little bit about ClaraPHI. ClaraPHI is an RIA, a registered investment advisory firm. Manage, call it, well, it was over $1 billion. Now we're, right at $1 billion with assets under management. ClaraPHI is really kind of set a place in the RIA space as a provider of alternative investments. We're a firm that has been really willing to embrace the use of alternatives in client portfolios, and as such, we've developed a reputation for being a great firm that provides very deep due diligence. We're one of the only firms in the country that will also provide diversified portfolios of alternatives for clients in as part of an overall asset allocation model. We have 4 offices around the country, actually quite a few more, but our major offices we're based out of Southern California in Aliso Viejo. We have our investment management team in New York City, an office in Washington, and then where our legal counsel and our president is based, and then a business development office in Florida as well. So, I was asked to see if I could talk a little bit about the current market and give some observations on the current market. And I think what we're finding right now is that there's a great deal of stress, obviously, that's taken place because of what's happening in the market. But what I like to tell people, and the way we want to start with that, is just to say this too shall pass. This is not a market-driven event that's happening right now. This is an external event that's causing a lot of dislocation for many, many people in the marketplace, and it's making people create a lot of fear, and there's quite a bit of uncertainty because of that fear and the dislocation. But the best way that we've been able to address those fears and that dislocation is through diversification. And so we'll always want to talk about, in the current market, diversification is actually a really, really big key to helping everybody kind of get through the rough waters that we're sailing through right now. Investors are always going to be seeking stability in portfolios. And when you have an event like this, it's going to make people very, very nervous, and they will start to pivot away from some of the traditional methods of investing, mainly the equity markets. And by equity markets, I mean the liquid equity markets, and then the traditional debt or bond markets. As a result of that, too, what we've had is more investors are actually looking for alternative investments. They're looking for alternative ways to provide that diversification and to provide that stability in their portfolios. And those are the things that we see in the marketplace today, that more and more investors will be looking towards ways to create diversification and create stability with the diversification, and using things that they maybe have not looked at in the past. And so we'll maybe go on next slide here, Eric, and we'll get that.
Hey, and Howard, you know, I see our slide is what are alternative investments. You know, earlier in my career, I was informed and a little bit shocked that real estate counts as an alternative investment. And then when people talk about traditional investments, they really are talking about the stock market or bonds. But maybe you could go into that a little more when you describe these alternative investments.
Yeah, I think that it's a good question and a good point that Eric brings up, because I think what a lot of people would consider, or what would they consider alternative investments, and what is a marketplace in our field, the investment management marketplace considers alternative investments. And anything outside of the liquid markets, that being liquid equities and bonds that are traded on a daily basis, are really considered alternative investments. Even though many of us would look at real estate as a very traditional base type of investment, in the investing world, if it's not a liquid investment, they're going to consider it an alternative investment. Therefore, what we have to do is we have to think about what are alternative investments and why are they important. And alternative investments, for most people in the country who have an investing background, they're already being used, and maybe not in the ways that they think, but maybe it's in their home, maybe it's in a rental property, maybe it's in their business. Those are all would be classified as alternative investments, and they do balance out the overall investment portfolio. And anytime you're working with an investment professional, they need to be looking at how these alternatives are used within the overall portfolio. Whether you have, like I said, holdings in a privately held company, your own company that you own as part of that portfolio, your own home or any other rental properties, art, cars. Cars are actually a really good alternative investment nowadays. They've held their value extremely well and are appreciated strongly. But those are different types of alternative investments that people would see. It's not just real estate. It's not just gold. It's not just your company. There's all types of different real estate investments that are available. And when we talk about what are alternatives, I like to look at alternative investments as a strategic investment, not a tactical investment. The liquid things are more tactical. Those are people who are trading, who might have entrance into the market one day and they're out within a week. When we're talking about strategic, we're talking about clients who have talked to you as an investor. You're talking to your investment advisor about your individual goals. What are your individual time horizons? What's your risk profile? People invest with certain goals in mind, and they have certain time horizons in mind, as well as they should be communicating what their risk profile is. Most people just don't want to trade on a weekly basis to try and make as much money as they possibly can. Some people do that, and they're good at it. But for the overall investing public, we all have goals that we're investing towards, and we all have a time horizon. It'd be nice if we all made enough money every year that we could just do whatever the heck we wanted to do and just get it done. But that typically doesn't happen for the majority of Americans. So we have a time horizon that we're investing over. And then we all have a risk profile that we're comfortable with. That's where some of these longer term horizons and that where what Urban Catalyst is doing with opportunity zones become a very, very useful tool in our overall asset allocation, because they give us the ability to really look at longer term time horizons and optimize the return to that time horizon with an optimal risk profile. So that's a little bit about what alternatives are. let's see. Next slide there, Eric. We can do
Sure.
that. There we go. So, so when we talk about alternatives here, what are alternative, or why alternative investments, I guess is the best way to say this here, since it's on the screen, is that, alternatives give us some tools to really emphasize our returns. Because alternatives are illiquid, the risk profile and the return profile are typically greater than what you would have with a very, very liquid investment, say cash or some stock that's traded, a blue chip stock that's traded, daily on the marketplace. Those things, because they are highly liquid and are viewed by the regulating bodies as more less risk-free investments, because the liquidity component also will perform on the typical risk return curve. The higher the risk, the higher the return. Lower the risk, lower the return. So that's why your cash right now is pretty safe, but it doesn't make anything for you. But alternatives do provide a higher potential for return, and they are also insulated from day-to-day market fluctuations. This is where most people will end up losing money in the marketplace, is when they see the fluctuations in a day-to-day marketplace, and they tend to, as we were talking earlier with another Urban Catalyst team member, they'll panic a little bit. So maybe they sell at the wrong time. So the saying is, buy low, sell high, but in reality, what most Americans will do is the opposite. They buy high and sell low. And that has to do with the day-to-day market fluctuations and their exposure to that. Alternatives provide us a longer-term play that align with the way here, ClaraPHI, the way we want to help our investors achieve their longer-term goals and a longer-term investment philosophy. Call it a strategic approach, not a tactical approach. Strategic approaches do have the requirement of letting time work for them and let time play out a strategy that's put in place. Anything that's short-term is tactical. There's a lot of things that are really good that come out of tactical investing, but from our perspective and for the majority of investors that we see in the marketplace, we're all looking for a little longer-term strategic type of approach. And alternatives give us the option, or the ability rather, to provide that type of strategic approach, because they are illiquid and they encourage us to stay in the investment longer and let the management team for that investment play out a strategic goal with the optimal return attached to that.
Howard,
yeah.
Howard, I want to jump in and give an example, for Urban Catalyst about, exactly what you're talking about. So right now at Urban Catalyst, we have around 120 investors in our fund. And of course, every single one of our investors, in order to receive the tax benefits, had a capital gains event. 70% of our investors, their capital gains event was the sale of stock. And what they were really looking to do is exactly what you're talking about. They were looking to invest in alternatives. They had their financial advisor saying, you need to not have so much money tied up in the stock market. You need to, diversify your overall portfolio. A lot of people think, well, I've made a lot of profits in the stock market in the last 10 years, and I just, I don't want to sell them because then I have to pay taxes. And that's where the tax benefits of opportunity zone funds come in as well. Interesting to note, when you're talking about buy low and sell high, the stock market in March, because of COVID, went down 30%. And we saw a lot of our investors called us and said, we're so happy that we diversified into a longer term play. And now that the stock market has rebounded somewhat from, bottoming out there end of March, beginning of April, we're seeing a lot of folks come back saying, you know what, we've come back and we want to diversify now. We understand what could happen. We saw it bounce back a little bit, and now's the time. So anyway, I just wanted to give you that example.
Yeah, no, I appreciate that, because that's really what ends up happening is, and it plays out to that saying, is that people will panic. They'll come back once they see the markets starting to come back, but they've missed the opportunity at the bottom. And that's a tactical approach. using alternatives is much more strategic. It lets us sleep at night knowing that we're not worried about the day-to-day market fluctuations, that we are trying to really play out a strategic investment, and that strategic investment will have a much greater return potential than any potential tactical plays that we may get right and some will get wrong. And so we're really looking at how alternatives will benefit the investor over the longer term. You know, Erik was mentioning, you know, tax benefits and alternatives, and that's another really interesting use for alternatives. But the primary thing that we always look at with any alternative investment that comes to the ClaraPHI platform is this a good investment? Number one, it has to be a good investment. Are the people behind it strong? Do we have the ability to, is the strategic plan doable? Is it executable? Is it something that we see that has potential to achieve their long-term goals? That's the number one benefit of working with alternatives. But alternatives also, and many of them do, have some great tax benefits. Opportunity zones in particular are probably one of the best that we've ever seen in the alternative marketplace. May not ever come around again. And it's very, very encouraging to see this out there. And for a lot of investors who are looking at alternatives and have capital gains that, as Erik was mentioning, this is really a once-in-a-lifetime opportunity to take advantage of a strategic investment in an opportunity zone with incredible tax benefits. And so we look at that and we say that opportunity zones can be a very, very critical and crucial part of somebody's portfolio if they have a longer term horizon. So, you know, what do we see ahead? And this is I'll qualify this by saying this is just my view. This is just pure speculation because, as any of us know, you know, guessing and knowing what the markets will do is a very, very tough business. But in my opinion, what do we see happening? I think there will continue to be a flight to hard assets and alternatives versus market-based assets. I think that the markets will continue to be very, very volatile for the term that we can see ahead. While we have some, you know, great big swings, they're much, much bigger than most people have ever seen. You know, yesterday we had a 900-point, you know, advance. Today I think we're down a little bit, but not much. Tomorrow it could swing the other way with some type of news. That type of volatility is very scary for most people. That's why I look at hard assets and alternatives as being a place where the future will attract more assets because it's much more predictable. You know, particularly with real estate. Real estate's a very predictable investment over the long term. We know it's gonna go up in value. We don't know how much, but we know it will go up in value over time because they're not making any more real estate. At least we're not making any more that I know of. I mean, unless we're going to the moon sometime soon in mass, we're not making any more here. So it's going to increase in value as we have more and more demand. You know, there's a possibility that there's some economic fallout from the pandemic might change the existing real estate dynamic. And a lot of people are talking about that. They're saying, well, you know, people aren't going to want to go to work or offices, you know, the office dynamic is going to change and people aren't going to want to live in multifamily, you know, high-rise condos anymore, and it's too close to each other and stuff. I look at all that as this is just a temporary and short-term dislocation. That trend is much, much larger than any virus that will ever hit our planet. The trend to congregate and be around people, that human spirit, that will overcome anything that we ever face like this. And so I just look at this as a shorter term trend. Maybe, you know, it lasts a year, 2 years. It's what's popular right now. It's what the media loves to talk about because they love encouraging the discord that we have in our country right now, and it keeps people watching them. But the reality is that the human spirit will conquer all this, and that we will be able to continue the trends that we've been seeing over the last, you know, 50 to 75 years in the marketplace. And you know, for everybody else, real estate will remain a tangible, valuable, hard asset, and it's the right thing for a lot of people. Most of our clients do have some kind of real estate already in their portfolio. Now it's just a matter of how do we diversify those real estate holdings in their portfolios, not just geographically, but across different asset classes as well. And then, we're also going to want to sprinkle in a number of other alternative assets. Maybe it is private equity. Maybe there is venture capital that we're adding in there. Maybe there are some other hard assets. But what I see ahead is that this is just the stuff we're facing right now is a short-term situation, but it is creating lots and lots of volatility. And if that volatility is really difficult for people, then we need to be looking at more alternatives and more strategic plays in our portfolio, something that doesn't fluctuate as much, something that we know over a period of time that matches our time horizons and our risk profiles will be able to achieve the goals that we all are communicating to our advisors.
Great, Howard. With that, I'll continue on and talk a little bit more about opportunity zones in San Jose, and then we'll get to the Q&A. So, as I mentioned when I was talking about 70% of our investors had stock as their capital gains event. Well, there are three primary types of capital gains events that we see when investors come to Urban Catalyst. The first is the sale of stock. The second is the sale of business, and the third is the sale of real estate. Interesting in the dynamic of what's happening now with COVID, stock has been, the primary generator of capital gains for investors into Urban Catalyst. But recently, the sale of real estate has really come on strong. Before, it was about 20% of our total investors, but that number is increasing as folks are finding out that their 1031 exchanges, they sold the property prior to the pandemic, and they're having a hard time completing that 1031 exchange. The three reasons I've heard, and we've talked about this in previous webinars, really are lenders are not, they're not comfortable giving the loans they're comfortable giving. The tenants in the building, only 30% of them paid rent last month. Now the lender is pulling back on their total loan amount, and the investor is unable to close escrow. The second is that there are just less properties on the market out there. People trying to identify a property to complete a 1031, they're not finding anything that has good returns in their opinion from a risk versus return profile. And really the third reason is they feel uncomfortable buying a property that they can't see. Obviously with shelter in place, it's been much more challenging to go out and actually view real estate. Most of you that are watching, I'm sure, are familiar with the Opportunity Zone tax benefits, but I'm going to go through them really quickly just as a refresher. By investing within 180 days of a capital gains event, investors are able to defer paying capital gains taxes for 6 years. So that means they don't have to pay their taxes until 2027. When they pay their taxes in 2027, they get a 10% reduction. So if they owed $100 in taxes, they only have to pay $90 in taxes. Now those are okay benefits, but it's really the third benefit that is the most important. And that is after our investors' money seasons in our fund for 10 years, our plan is to sell all of our assets and distribute all of those profits to our investors. And all of those profits are tax-free after 10 years from a federal capital gains perspective. So what sets Urban Catalysts apart from other Opportunity Zone funds? We have 7 projects, so we're not a blind pool. We're very well capitalized. Our executive team, we've been doing development for many years, specifically here in downtown San Jose. We're both a development company and a fund manager, so that makes us different. Also, all of our projects right now are pre-construction, which is really a benefit to us here at Urban Catalyst with this pandemic happening. We didn't have any construction shortfalls or delays. Also, right now, we're not out looking for any senior debt financing. So even though the capital markets are somewhat closed still, we're not going to be going out looking for capital from senior debt providers until really the end of this year, and by then the markets shall have reopened. Now, just to show you, for everybody out there that's not from San Jose, here is downtown San Jose. You can see 4 census tracts overlay downtown San Jose that are designated as opportunity zones. I get a ton of questions from folks. Downtown San Jose, they call it the capital of Silicon Valley. How is this an opportunity zone? And really the answer is when they designated the census tracts as to what qualifies as an opportunity zone, it's lower income census tracts, but defining lower income as in proximity to other census tracts surrounding it. So over here to the south of downtown and to the west of downtown, these are some of the most affluent neighborhoods in San Jose. And by comparison, downtown San Jose is a lower income census tract. Now, Howard mentioned this, but I want to reiterate it because I think it's really important. When we talk about alternative investments and we talk about, long-term vision, and I mentioned specifically tax benefits, and Howard said, well, yes, tax benefits, great. Opportunity zone funds have been called a once-in-a-lifetime tax opportunity. But it's really the underlying real estate that matters. It's really about how good are your projects and how good is the development team that's doing your projects. If there's no profits after 10 years, what's the point of having tax-free profits? And so just wanted to reiterate, it is about the long-term play. It is about the underlying projects when you think of alternative investing. Here, I want to give you guys a little bit of an idea of where Urban Catalyst projects are located here in downtown San Jose. This black line represents the opportunity zone. Here is San Jose State, which I talked about earlier. Here is the BART line that's connecting all the way down Santa Clara Street to Diridon Station, one of the largest multimodal stations here in California. This is the SAP Center where the San Jose Sharks play. Here is Urban Catalyst headquarters. So we're located right in the heart of the zone where we're doing all 7 of our projects. We're right next to Adobe's headquarters. Adobe's been in downtown for 26 years. They're currently building a 900,000 square foot office tower to add to the other, that's right here, to add to the other 3 that they currently have here. What is interesting, which everybody, of course, has been talking about in San Jose, is Google. Google, over the last 10 years, has been really implementing their decentralized headquarters strategy where they want folks to be able to have shorter commute times to drive into their offices, or if you look at it a different way, they want people to be able to afford to be able to buy a home and rent a home and not have to commute into their campus. I mean, in Mountain View, single-family home prices average $2.5 million. So Google has slowly been moving south through Silicon Valley, and their most recent acquisitions are here in downtown San Jose. In the past 12 months, they purchased $450 million worth of property. They just closed on another property last week. Their plan is to build 7.5 million square feet of office and 5,500 residential units. And that'll bring around 100,000 people into downtown San Jose every day. Sometimes people talk about, what is going to be the Google effect? And I think of it in a different way. I think of Google as the effect of San Jose's strong fundamental real estate market. I mean, you talk about Google coming to town. Jay Paul is a regional developer. He, in the last 8 months, has purchased $650 million worth of property in downtown San Jose. This was that light switch turning on that I saw 2.5 years ago in downtown, and why I formed Urban Catalyst. I wanted to get on the ground floor, acquiring properties at the right prices. And I did just that. We acquired 7 projects here in downtown San Jose. We have a extended stay business hotel. We have a residential project. We have a senior living facility, which is assisted living and memory care. We have 2 office projects here in the core. Right next to the BART station at City Hall, we have a high-rise residential tower. And then down here on 4th Street next to San Jose State, we have a high-rise student housing project. We have a very diversified portfolio in order to reduce the overall risk to our investors. These are our 7 projects. You can see, that diversity in the different types of projects that we're doing. I'm very proud of these projects. All of these projects will start construction next year. Now, as far as timing is concerned, I get a lot of questions about, when will we be distributing funds back to our investors? So I want to just go through this really quick. We plan on raising money in 2019 and 2020. We're closing our fund for investment on December 30th of this year. First time we give money back to our investors, this is a part of our refinance and distribution program. What this really means, and this came out as a part of the April 2019 Opportunity Zone guidelines from the Treasury and the IRS, but what it says is when we build our buildings, we lease them up and we stabilize them. We go out, we get permanent financing. I mean, that's just developer 101, right? We take that permanent financing and we pay back our construction loans, and then any excess refinance proceeds, we can distribute to our investors tax-free. So that is a huge benefit to this program. And what we're targeting right now is that we're able to distribute around 75% of our investors' initial investment back to them from 2023 to 2026. You know, what's interesting about the Opportunity Fund program, because of the 10-year hold, the long-term vision, what we're seeing is in the first 5 years, we're really a value add fund where, you know, we're creating these projects and adding this value. And then in the second half of the fund, we're more like a core fund where we have stabilized assets and cash flow. So we're going to have cash flow above and beyond what we pay in debt service from 2025 to 2030. And then, as I mentioned, after 2030, that is when we sell all of our assets and we return tax-free profits from a federal capital gains perspective to our investors. All right, with that, I just remind everybody, please ask questions in the Q&A box, and Howard and I are more than happy to go through and answer all of these questions for you. Let's see what we got. Howard, you ready? So, first question. Howard, what experience does ClaraPHI have investing in the alternative space?
Yeah, so I appreciate the question because it's something that you have to look for with firms when you start to talk about alternative investments. And we've been in the space for about 6 years now. One of the founders at ClaraPHI, the CEO, Valley Nass, has been using alternatives for more than 20. Myself, my own experience has been 20 plus years with alternatives. I've actually done some of the development work as well, like Erik is talking about, and developed space here in my hometown of Phoenix. I've done private equity and a lot of venture capital work. And one of the things that's interesting about what we bring to the table is that we have developed, because of our willingness and a desire to be in the space, we've developed a very functional due diligence process, which is comprised of 4 components. You know, we get to know the principals extremely well. We do our own deep dive with financial analysts who look inside and outside of the company, both financially and reputationally. We use an outside third-party diligence firm as well. And then we also perform ongoing diligence with every one of the sponsors of these alternative investments that we work with. So, that's a little bit of our, what makes us good at it and why we feel comfortable in the space.
Howard, I'll add on to that. Just my personal experience working with ClaraPHI. Met Valley and Howard. They flew to San Jose. They met me and my other 4 partners here at Urban Catalyst. We toured all of the projects. Then we started the due diligence process with them. Went through an extensive process, but we worked very quickly to be added to their platform. As Howard mentioned, third-party reports. Urban Catalyst has a fact-right report that anybody out there can look at and see. But it was interesting talking with Valley and Howard, and what they really said was, we want to meet the principals first. We want to make sure that this is a good investment, learning about who this project development team is. Then if we like the team, then we'll learn about what the projects and assets are. Then if we are very comfortable with that, then we can start the due diligence process. So ClaraPHI obviously does their homework when it comes to vetting and understanding these types of investments. Let's see, Howard, how do you compare opportunity zone funds to other types of private equity investment?
Yeah, so it's an interesting question. So opportunity zone funds are, as I said earlier, are a once in a lifetime gift to us from the government. So when you look at typical private equity types of investments, there's different approaches in private equity, whether it's Private equity is associated with real estate. It's private equity associated with equity investments or ground up development. There is private equity associated. It's really the next stage of venture capital with companies as they seek either, capital to grow, or they seek capital, to do different things with their businesses. It's typically revolving around some type of growth initiative. But, urban, not urban catalysts, but opportunity zones, including urban catalysts, really bring a unique view in that it is a strategic plan, and there's a defined entrance, there's a defined type of project, and there's a defined exit. And those things are really key to us in looking at opportunity zones as a great component of a client's portfolio. Private equity is, we use it in a lot of different places, and it's a great way to develop wealth in this country, but it's not for everybody because of the risk profile with private equity. There's often there's not a lot of transparency sometimes, and it's very difficult, and those are not waters that you want to try and venture into yourself. You need professional guidance and assistance with that. Opportunity zones tend to be a little more transparent, and they definitely have the strategic view that we like to look at.
Howard, here at Urban Catalyst, transparency is a huge issue for us, and we really work to be as transparent as possible, not only to our investors, but also to all of the registered investment advisors and broker dealers that we do business with. And one way that is really done for us, because we are both a fund manager and a developer, you can see every single fee that is charged, every promote, every single thing in our private placement memorandum. Most of the time when you're looking at investing into an opportunity zone fund, they're a fund and they show what their fund level fees are. But their plan, of course, is to partner with developers across the country, do development projects. You don't know what those developers are getting as far as what their fees are or what their promote is. And here at Urban Catalyst, we're extremely transparent, allowing everyone to see everything that we charge, and everything that we charge is market rate, so there's no surprises. Let's see. We have a question. Does it concern you that big tech like Google, Twitter, and Facebook have all announced their longer term work from home strategy? So Howard, I know that you addressed this earlier. Maybe I'll address it from my perspective a little bit. And of course, Howard, I agree with you that, fundamental human nature is going to bring us back to a more normalized society. And that, of course, this is the media talking about, oh yeah, no one's ever going to work in an office ever again. Everyone's going to work from home. What it kind of reminds me of is after 2001, when the World Trade Centers went down, everybody was talking about no one is ever going to lease high-rise office in Manhattan ever again. That's just not going to happen. And of course, it came back stronger than ever. Transit-oriented development, which is, it's like the holy grail now of modern urban planning. Building transit or building high-density office, residential, everything near transit stops. That's not going to change. We can't go to a society where everybody has offices that are campus offices and everybody lives in a single-family home that is spread out across the whole country. Traffic would be crazy. It just is not an efficient land use. We'd kill the environment. The traffic is going to burn, gasoline is going to go into the air, and global warming. We need to build density near transit, just like we always have. And it is a long-term vision. Humans have been living in groups our entire existence for thousands of years, and a virus that lasts for a year or two at longest is not going to change that overall philosophy, no matter what Twitter says to try and improve their losing stock price.
Yeah, Eric, I'll just throw in real quickly on that too. And this is, as I said earlier, this is a short-term trend in the overall, look of life here. This is going to be a 6 month to year event. Everything will go back. once you heard the news from I believe it was Sorrento Therapeutics, that they have a cure for corona. You've got Moderna Pharmaceuticals working on the vaccine. This is a short-term event. It's being hyped by the media for their own purposes. That's how they make money, right? The more eyes are on them. So you've got to understand where that's coming from. But the overall trends, as Erik mentioned, are just too strong in human nature as well to be overcome. And it's gonna keep on. It's gonna grow, and the urbanization of not just the United States but the rest of the world is a trend that just won't be overturned.
One thing I think is interesting too that I'll mention, with this social distancing, we're going to be returning to work here more than likely in the next couple of weeks. And here at Urban Catalyst, we have 22 employees, and we're looking about how we're going to, space everybody out to make sure that everybody is safe as we return to work. And the trend here in Silicon Valley for really the last 10 years is putting more people into less space. It used to be the standard was one person per 400 square feet of office. And over the last 10 years, right now, Google and Facebook are averaging like one person per 150 square feet. And WeWork's whole business model was one person per 50 square feet. Now, if anything is going to happen, what I see, at least from an office market dynamic, is these big tech companies, they're going to need more space. They're going to go in the reverse direction of that trend, allowing their employees to go to maybe one per 200 square feet or one per 250, which is only going to continue the demand for office. All right, I'll go on to our next question. Let's see. We have a Urban Catalyst question. What is the minimum investment amount? The minimum investment amount, if you work through a broker-dealer or RIA, is $100,000. So that is the answer to that question. Let's see, the next one. I had a recent capital gains event, but I wanted to keep some of the cash. Can I choose how much I want to invest, or do I have to invest my entire gain into an opportunity zone fund? The answer is you can choose how much you want to invest. You only need to invest. You only need to invest how much you're comfortable with. You just have to pay taxes on the remaining portion of that gain. But what we see right now is that folks in downturns like this, cash is king. They want to see some liquidity, and so sometimes they're choosing to keep some cash while invest only a portion. And opportunity zone funds are a great solution for that. Let me see here. Howard, what makes you an expert in alternative investments?
Well, I'll say that expert's always a relative term, but if you want to just look at experience, that's probably what would be the greatest attribute for being an expert in there. And over the last 30 years, I've made a lot of money in alternative investments, particularly with some real estate and some venture capital stuff I've done. And I've also lost a lot of money in alternative investments, and that being through some of the crashes. And so the lens that you look back through when you have an experience on both sides of what happens for the investor gives me a unique view and maybe a unique set of experiences, and therefore being an expert in how do I work with alternatives and how do I help other investors have that same type of experience without having to go through the same types of pains that I've gone through. So it's those learning experiences are very, very valuable. It's tough to communicate what risk is until you've been through risk, and I'd say that's probably what makes me more of an expert. And our firm at ClaraPHI, we've developed a process, and we've been doing it for a while. The process has worked, and our belief in diversification is probably what gives us the greatest ability to serve our clients and their clients as well in providing that expertise within the field of alternative investments.
Great. I have another question for me here at Urban Catalyst. How have land values fared during the pandemic in downtown San Jose, and have you acquired your land already? Uh, so overall, I mentioned we have 7 projects. We've acquired 6 of the 7 pieces of property. The 7th property we're in a long-term contract, we acquire in December of this year. Overall, land values in San Jose haven't changed yet. Whether they go up or down remains to be seen, but typically what happens is it's a 9 to 12 month lag from when there's a major event to when you see transactions starting to occur. I mean, obviously nobody's going to put their property on the market during a pandemic if they think there's going to be some sort of discount, so you see a lot less volume. That being said, Urban Catalyst, we acquired our projects in downtown, and that's really our strategic advantage doing business here in San Jose. Local developers doing projects. We know all of the property owners in downtown San Jose. We've been doing business here for 15 plus years. And when we go out and acquire property, it isn't like we're responding to brokers' flyers. We're having conversations with the property owner directly off market, or if we are working with a broker, we're the sole person the broker is taking it to, or maybe they've taken it to a handful of people. We do not enter bidding competition. So because of that, we've been able to acquire our properties at what I would say is a below market rate value. And regardless if property values go up or down here in downtown San Jose significantly, what really matters, I say this because property values in a total development project, across our 7 projects, they average around 15% of the total project costs. What really makes up the majority of those project costs are hard cost construction costs, which are over 50% of the total project costs. And when we talk about what really matters coming out of a recession and really how we're positioned to take advantage of what is out there as far as the distressed market, is I look at construction costs. Urban Catalyst, we have 10 developers that work here. We went back and looked at the projects that we had construction cost estimates on in 2007. We wanted to see historically what happened to construction costs during the last recession. And what we found is that really across the board, we saw, before and after the 2008 downturn, around a 20% decrease in construction costs. And what that matters, how that would affect us now if something like that happened, is we have around $600 million in total hard construction costs as a part of our portfolio. If we saw a 20% reduction, that would be a $120 million cost savings to our investors. And that is significant. It's more than double all of the land values that we've acquired. So that's what we're looking at as far as what's going to happen in the next year and how we're positioned to take advantage of that as a well-capitalized firm with a long-term vision. A lot like Howard said, alternative investments is a strategic play and less a tactical play. Howard, do you have anything else you'd like to add before we close this webinar?
I think the one thing I'd like to emphasize to people again is that be positive. This is a short-term blip in our overall growth as a country and as an economy. We love the idea of opportunity zones. I think that the opportunity zone, as I said earlier, is a gift. And if you can take advantage of this gift, we need to be looking at that for every individual who has an opportunity to look at that. But I will emphasize again that we always look at investments that are on our platform as great investments first. The other benefits that Erik has mentioned, the tax benefits, etc., are nice things to have in opportunity zones. But this is a great investment first, and that's what we're always going to look at adding to our platform.
Excellent. Howard, thank you so much for joining us again today for the Managing Market Volatility with Alternative Investments webinar. You can always learn more about Urban Catalyst by going to urbancatalyst.com. And Howard, with that, we're going to say goodbye. Thank you so much.
Thank you. Take care.